Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. Ever since I was a kid, anytime someone was trying to convince me of something, or when people were trying to convince anybody of something, they would use expressions like, you can bank on it, or you can take it to the bank. And, the idea was that of all the institutions out there, the banks were considered some of the most trusted. You could always trust the bank to protect you and protect your money. But then all of a sudden, we ended up coming into 2008 and 2009, and all the reckless lending and reckless financial, almost corruption that occurred during that time, which instigated the Great Recession of 2008, 2009. All of a sudden, banks weren't trusted as much anymore. And to kind of give you some insight into that, I often talk about how overvalued I believe the market is right now. We've had this since the Great Recession, this great long-lasting bull run. I always say it's a market of stocks, not a stock market. And so even though I consider the market overvalued, there are certain sectors where there is a lot of value. One of them is healthcare, and the other, of course, is the financial institutions, the banks and the insurance companies and so on. So, they've been trading at very low valuation multiples compared to the rest of the market because there is a shaking or a lack of confidence. But hopefully that's beginning to change. And there was a couple of articles posted in the Wall Street Journal this week that I think show that there might be a change, especially when it comes to the financial institutions, the banks specifically. So let's go ahead and look at the articles that were posted in the Wall Street Journal that kind of articulate what I'm talking about here. The first was the article that said the Fed gives the big banks a clean bill of health in the latest stress test. Stress tests gauge banks' ability to maintain strong capital levels and keep lending in a hypothetical severe recession. And, the banks have been really also held under some restrictions by the Federal Reserve. But as of this announcement on June 24th, they gave the large banks a clean bill of health as they emerge from the coronavirus crisis, paving the way for the lenders to boost their payouts to investors after today, June 30th. So in a vote of confidence for the banks, including Goldman Sachs and Wells Fargo, which is kind of important, the Fed on Thursday said it would end temporary limits on dividend payments and share buybacks after all 23 firms performed well in the annual stress test. Now, that was kind of good news, I'm sure, for the banks. And then in the Wall Street Journal on June 28th, we had this article where Morgan Stanley, Goldman Sachs boost shareholder payouts. What this talked about says that the largest U.S. banks would boost their payouts to shareholders after the Federal Reserve affirmed that they are healthy enough to do so. So in that regard, there were 6 financial institutions that were mentioned in this last article. That was Wells Fargo, Bank of America, JPMorgan, Morgan Stanley, Goldman Sachs, and Citigroup. So what I did for y'all here on the channel was I created a portfolio in FastGraphs called banks, and I'm going to cover these 6 financial institutions. So let's first of all put them in order of earnings yield, highest to lowest. The highest earnings yield is Citigroup, and I like to see at least a 6.5% to 7% earnings yield to call it fair value. Citigroup certainly meets that bill. Goldman Sachs at 9.2% meets that threshold. Morgan Stanley, which by the way is my favorite, and I'll be talking about that more, has a 7.44%, and then JPMorgan at 7.1%, and then Bank of America at 6.03%, which is really kind of a misnomer. And so is Wells Fargo, and that's because of some very interesting things going on with their earnings, which I'll be showing you as I go through the video. But let's start with these companies, and let's look at, first of all, Wells Fargo. Now, this is my least favorite in the group for the following reasons. Number one is, I do want you to notice that this company has had really poor performance, really going back to 2014. And I'm talking about operating performance now here. There's been very, very little or almost no growth that the company has achieved. The stock price has flatlined, as you can see. And then along with COVID, this was the one bank, Wells Fargo was the one in the whole group that cut their dividend or slashed their dividend during the COVID crisis. All right. And, it was the only big bank to do that. But now they also decided, though, in this last report that I shared with you earlier, they've decided to double their dividend to 20 cents a share. And that's great, 100% dividend increase, but they're not paying much in the way of dividends in the first place. Their current yield without that announcement is 0.89%. And again, they've got a very high valuation based on the fact that their price is trading significantly above their earnings. Now, even though they're expected to have a strong recovery this year, they're still not expected to recover back to what they were going back, 5 or 6 or 7 years. So Wells Fargo still has some issues. Now, looking further out, the company does look attractive if you believe these estimates are going to be, reasonably accurate. And the company has in recent years, a relatively spotty record. If you look at the 1-year forward forecast, they've missed it twice by rather large margins for 2019, which of course was COVID, as well as 2020. But they also had an issue in 2016. So this company does have some blemishes on their record, and it's the one that I like the least of the group I'll be covering here. The next one is Citigroup that I want to talk about. And Citigroup is very, very interesting. This is probably the most, famous and biggest bank in the world prior to the 2009 financial crisis and recession. And if you look back at these stocks, they were generating good performance. I don't have the data to go back any further, but the point is these banks were doing really well. They were making a lot of money. And then the whole lax financial, criteria caught up with them. And look what happened to this company. Their stock price fell from $551 a share all the way down to $15 a share. That's a 97% drop in value, but that was also accompanied with an 83.7% drop in earnings, followed by a 765% drop in earnings, where they had a negative $47.90 of earnings, followed by a negative $8 worth of earnings in 2009. I mean, this company was in really bad trouble after that. Now, if we look at what's happened to them post the Great Recession, they've begun growing again. They started increasing their dividend again in 2015. And, the company right now trades at a blended PE of 10, has an earnings yield of 10%, and a dividend yield of 2.9%. Now, relative to what they announced during this announcement, they were the lone mega bank not to increase their dividend. They're keeping it unchanged at 51 cents a share, but they are leaving the door open for an increase, and it did not also announce a buyback plan. So of all the companies mentioned in this article, it's showing no participation. What it has going for it is a very inexpensive valuation. It's providing an earnings yield of just under 8%, dividend yield of almost 3%. So perhaps they didn't feel the need to raise their dividend like some of the others, because it's already got some pretty good fundamentals relative to their yield and so on and so forth. So Citigroup probably looks very attractive here, and maybe they'll ride the tide if the other big banks continue to prosper as a result of this. But I also want to point out that here's this low valuation I'm talking about. The blue line on this graph is a PE of 11. These companies used to trade at 15 to 20 multiples and even higher, but since the Great Recession, they've been trading at relatively low multiples. Anyway, that's Citigroup. It's been kind of cyclical, kind of spotty. It really hasn't got a lot of mojo going for it, but it's got some. And again, you might want to take a closer look at Citigroup. Goldman Sachs has also been a very cyclical company, except for the dividend. If you notice, their dividend record has been pretty good. They did have a couple of times where they cut it, 7% in 2010, which is no big deal. They froze it in 2001 and 2002. They froze it again in 2010 and 11 after cutting it in 2010. They had very modest increase in 2016 and so on. So Goldman Sachs has a record that's pretty good, though, for the dividends, considering now they raised their dividend to $2 a share from $1.25. Now that's, very, very interesting, because they were expected to be paying a $6 dividend by 2022, and I'll shorten this time frame so you can see this better. But it looks like they'll be paying a $6 dividend, starting maybe this next quarter after this quarter ends, because they've already announced that they plan to raise it. So that's kind of nice. That's not showing up in the data yet, but it will be showing up pretty soon. We've got an earnings yield of 9.27%, a dividend yield of 1.34%, which is going to increase by, a pretty substantial margin from a $5 a share dividend to $6 a share dividend. So that will be, pretty attractive for Goldman Sachs. The next company I want to look at is Bank of America, in the same class as the Citigroup. We saw this, trading at this nice 15 well, actually it was an 11 multiple here during all these years. You can see where it followed it. Then we had this big collapse in profits. They did end up losing money in 2009. Their earnings fell 80% and then 150%. Then they had a nice little rally, and then their earnings have been kind of sketchy, and their dividend is starting to grow again. When Bank of America said they would increase their dividend to 21 cents a share from 18 cents a share, so that's kind of a modest increase. But they also announced an open-ended $25 billion buyback plan. I don't particularly like that because I think the valuation's a little high here for them to be buying back their stock. But if I shorten this time frame, you get a different perspective of valuation. I do want to point that out. They are trading at about a 16 blended PE. I'd like to see it at 15 or lower, but it's been trading at that here in recent times. But anyway, there's Bank of America. Next, we have JPMorgan, another major diversified bank. JPMorgan went through the Great Recession and the financial debacle better than most, as you can see here. Their earnings did drop 81% because they did participate to some extent, but they did stay profitable, although they did slash their dividend from $1.50 to 20 cents. But then for the last several years, their dividend record has, been pretty nice. They've been increasing their dividend at about a 15% rate since 2012. That's very, very, very attractive. They said they would lift their dividend to $1 a share from 90 cents a share, and they did announce an open-ended $30 billion buyback. The stock has an earnings yield of 7%, buy it at a blended PE of 14. And again, you can see, though, that it's been a 12 multiple stock for much of the time coming out of the Great Recession. Again, the confidence in the financial institutions was shaken. Their near and long-term growth expectations are pretty strong, however, and they've all gone through with these stress tests. So JPMorgan might be one with a 2.3% dividend yield you might want to take a closer look at. It would probably be my second favorite, if you will, in the group. And then finally, I want to take a look at Morgan Stanley, which is actually the favorite right now in the group for me personally. It's one that I like, and I might be adding to client accounts in the future coming up here. They actually doubled their dividend to 70 cents a share, and they plan to add a $12 million backup on their stock in the next 12 months. They got a nice pop in the market yesterday. Their stock was reasonably flat today. They're trading at a blended PE of 13.44 as of yesterday's close. Earnings yield of 7.44%, a 1.5% dividend yield, which is now going to increase to 3%, after they double the dividend. So that'll be, a lot more attractive. Again, that's not reflected in the data here. I like the fact that they're expected to have good, solid performance going forward. Their long-time trend line growth is not necessarily that strong, but if I mix it up in the custom calculator here, there's a lot of potential upside of them going back to a 15 PE ratio, which I believe they will. I just consider this with the dividend yield and everything else going for it in the share buyback, and the fact that they've put together a very consistent record since coming out of the recession once they got past 2010. I just kind of like that. I like that kind of consistency when I'm looking at stocks. Anyway, this has been Chuck Carnevale saying thanks for watching my presentation here on the big banks and all the news that's happening. They've passed the stress test. They look healthier than they have in a long time. The Fed's given them the green light to raise dividends and do share buybacks. I think those are all good things. So, maybe the sentiment and the attitude towards the big banks is going to change. Anyway, if you like the video, give me a like, ring the bell, thumbs up, subscribe to the channel because we appreciate you very much. And, I look forward to talking to you again real soon with another video. Thanks for watching.